In 1992, Shaquille O'Neal walked into a bank and deposited his first $1 million check. By dinner that same night, he was $80,000 in debt. Today, Shaq is worth close to $500 million, but almost none of that money came from playing basketball. There's even a good chance you spent money recently at one of his companies without even knowing it. So how do you go from blowing your first million in an afternoon to building a $500 million empire? Shaq figured it out with a simple investing blueprint that made the good decisions huge and the bad ones survivable. All right, let's get into it. Phase 1, the $1 million check that left him $80,000 in debt. Shaq would go on to win 4 NBA championships and earn 15 All-Star selections. That said, basketball never taught him how money actually worked. In June 1992, Shaq left LSU as the #1 overall draft pick, and every major shoe company wanted to sign him. At the time, rookies didn't walk into the league expecting signature sneakers. You earned that over years after you proved yourself on the court. Shaq asked for one anyway. Nike passed. They had Michael Jordan already and had just signed Alonzo Mourning, the #2 pick. By Shaq's own retelling, Nike told him they had enough stars. But Reebok saw things differently and gave Shaq exactly what he asked for: a signature shoe, creative input, and a contract reported at around $15 million. It was the largest shoe deal ever handed to a player who had not yet made his NBA debut. Shaq still flew out to Nike afterward, only because he had promised he would, and showed up wearing Reebok head to toe. Then a second brand check arrived, and that one taught him something far more expensive. A trading card company paid Shaq roughly $1 million for an endorsement. One summer afternoon, his agent called to say the money was ready. Shaq picked up the check, drove straight to the bank, deposited it without reading any of the details, and started spending on the way out the door. His first stop was a Mercedes dealership. Shaq had wanted a black Mercedes since he was a kid. He walked into the dealership, wrote a check for $150,000, and drove off the lot in the dream car he'd wanted his whole life. When he got home, his father took one look at the car and asked where his was. So they drove back and bought a second one. Then his mother wanted one too, so they went back a third time. Then came the jewelry, the tailored suits, and everything else that a 22-year-old suddenly believes he can afford after depositing a $1 million check. By the end of the afternoon, the $1 million was effectively gone. A few days later, the family's bank manager called and asked Shaq whether he actually knew how to read a bank statement. Shaq was negative $80,000 in the hole from that spending spree, and the spending was only half of it. Shaq had no working understanding of taxes and didn't understand one basic component about his $1 million payday: that $1 million was never $1 million. Shaq would owe multiple hundreds of thousands to the IRS. Making money, Shaq would later say, is one skill. Keeping it is a separate one, and that's true. So Shaq started taking meetings with financial advisors, but walked out of nearly all of them. Shaq commented later that every single advisor he met with was pitching guaranteed large return on investments with little to no supporting information to back their claims. Then Shaq met an accountant named Lester Nispel who pitched him the most boring investment strategy in the book. Instead of selling Shaq on guaranteed returns, he picked up a $100 bill and tore it in half and told Shaq $50 gets saved, and told Shaq that $25 of it had to be saved for taxes as well. It is an absurdly simple wealth building strategy, and Shaq has run it for the last 30 years. Today, Nispel is still Shaq's business manager and has been a driving force in Shaq's entire empire. 6 years after they met, Reebok offered Shaq a $40 million deal, but Shaq turned it down for a reason that didn't make sense to anyone else at the time. But it turned out to be a turning point in Shaq's business ventures off the court. Phase 2, the stranger who convinced him to turn down $40 million. By 1998, Shaq had turned into exactly what Reebok had hoped for. The shoes were selling, and Shaq was constantly performing on the court. Reebok came back with a new offer worth $40 million over 5 years. Almost any athlete alive would sign that deal without giving it a second thought, but Shaq walked away from it. The reason why was a single conversation outside an arena in Orlando. A woman stopped Shaq after a game and complained about the price of his sneakers. She said kids in her neighborhood could not afford them and wanted to know why athletes kept putting their names on shoes that families like hers would never be able to afford. Shaq reached into his pocket and offered her $2,000 in cash that he was carrying. She slapped it away. She didn't want his money. She wanted Shaq to build a shoe her family could afford. Shaq passed on the Reebok money and launched his own line under the Dunkman logo. The shoes went into Walmart at $20 a pair. Every other superstar in the league was racing to build the most premium basketball shoe on the market. Shaq ran at the opposite end of the market, and by his own account, the brand has moved over 400 million pairs to date. Now, look at how Shaq financed it, because this is the part that matters. Shaq did not put up the capital to fund the project. ACI International and Warner Brothers funded the shoe line, handled manufacturing, strong and carried all of the downside if it failed. Shaq contributed to the demand and marketing and kept a share of the upside. Shaq would run that same structure again and again for the next 20 years. Bring the most valuable asset that only you have to the table and let someone else's balance sheet carry the risk. Meanwhile, the company Shaq walked away from was making a bet of its own. In 1996, Reebok signed Allen Iverson, skinny rookie out of Georgetown, to a 10-year deal worth a reported $50 million. Iverson gave Reebok everything it could have ever wanted: crossover, the cornrows, and a signature line that still sells and is talked about today. And in 2001, Reebok gave Iverson something no athlete in company history had ever received: a lifetime deal reported at $800,000 a year, plus a separate $32 million trust that Iverson couldn't touch until he turned 55. Iverson earned more than $200 million across salary and endorsements from Reebok. By 2012, court filings revealed that most of that fortune was gone. The trust survived, and it survived for exactly one reason: Iverson was contractually prevented from touching it, no matter how bad his spending habits got. Reebok's lawyers had accidentally built Iverson the only structure that could outlast his own poor spending decisions. In 2021, Adidas sold Reebok to Authentic Brands Group. 2 years later, Shaq came back to the company he had walked out on as president of Reebok Basketball. Remember the name Authentic Brands Group. It shows up again and again later in the biggest deal Shaq ever signed. But before we get to that, Shaq spent an entire decade quietly acquiring some of the most mundane businesses in America. Real quick, if you're getting something out of this, hit subscribe. This channel breaks down operators and the money systems behind them. New breakdowns every single week. Now, the biggest deal of Shaq's life started with him giving away the rights for his own name. What he asked for in return is what turned that decision into a 9-figure return. Phase 3, the franchise king. In June 2011, Shaq retired from the NBA after an epic 19-season career. Now, most retired NBA players see their biggest check stop coming the moment they retire. But Shaq's NBA retirement ended up being a promotion. Turner Sports signed Shaq to Inside the NBA on a deal reported at roughly $10 million a year. That check covered his entire cost of living, and it came from a job Shaq would have done for free if he could. Every dollar of his NBA career could now sit inside his portfolio and grow, while his Turner Sports money could fund his lifestyle. This is the floor for everything Shaq's post-NBA empire was built from. Shaq had been putting money to work long before he retired. First big one was actually an accident. In the early 2000s, Shaq sat down for a lunch at the Four Seasons Hotel with a table of businessmen. The table would not stop talking about a new search engine company called Google. Shaq knew nothing about search engines, but trusted the room. Through one of those connections, Shaq invested in Google pre-IPO in 2004, and it's safe to say that investment would go on to pay off. The question Shaq started asking after that lunch matters more than the return. And he has run it on every deal since. Where does the money go that people stop noticing because they use it every single day? That question pushed Shaq into franchising. Shaq spent his last playing years and the decades after assembling one of the largest franchise portfolios any athlete has ever known. At the peak, Shaq controlled 155 Five Guys locations. The portfolio also contained 17 Auntie Anne stores, a Krispy Kreme in Atlanta, several fitness centers, and 150 car washes. A car wash does not care who won the championship, and a pretzel store does not have a bad quarter because the roster got rotated. Boring businesses throw off cash in good years and in bad ones, and that steadiness buys you the right to never sell anything at the wrong moment. Then in 2015, an $80,000 security quote reminded Shaq of the same thesis. A contractor wanted $80,000 to wire up the security at one of Shaq's Atlanta homes. Shaq thought the number was ridiculous, so Shaq drove to Best Buy, bought a set of Ring cameras off the shelf, and installed them himself. Weeks later, Shaq was in China when somebody rang his doorbell back in Atlanta. He opened the app on his phone and spoke to them from the other side of the planet. A doorbell that Shaq set up himself had just done the job a contractor wanted $80,000 for. This is the moment Ring stopped being a gadget for Shaq and became a business. At CES later in Las Vegas, Shaq spotted the Ring booth on the show floor and walked straight up to the founder. Ring had been turned down on Shark Tank 2 years earlier when Jamie Siminoff had asked for $700,000 for a 10% stake and priced the whole company at $7 million. Shaq did not ask Siminoff for a discount or a free unit. By his own retelling, Shaq wanted to invest directly, and that Ring was going to pay him to do the commercials on top of that. Now, look at what Shaq just built. Shaq took a fee for the promotion, which cost him nothing, and equity for the upside, which cost him a check. Richard Branson put $28 million into Ring in 2015, and 3 years later, Amazon bought the company for a reported $1 billion. Jeff Bezos once told Shaq to put money into businesses that change how people live. Shaq has said that that single reframe of judgment quadrupled his net worth. So by 2015, Shaq had the floor, the capital, and the pattern. What Shaq did with those three things over the next 10 years is what turned a basketball fortune into a balance sheet. Phase 4, the deal bigger than everything else combined. By 2015, Shaq had investments all over the place. He had real estate, franchises, an NBA franchise, and then Shaq signed one deal that quickly outgrew all of them combined. For years, Shaq had been licensing his image one contract at a time. Clothing here, footwear there, toys, consumer products. Each segment was negotiated separately, each one expiring on its own schedule. Then Authentic Brands Group came to Shaq with a different structure. ABG proposed that Shaq would move most of his licensing rights into a joint venture called ABG Shaq LLC. ABG would run the inventory, the contract negotiations, the manufacturers, the global distribution, and would also push Shaq's name into categories he had no infrastructure to reach by himself. Upon hearing ABG's speech, Shaq didn't ask for a bigger fee. Shaq asked for equity in the company itself. Shaq bought a share of the company that licenses everybody's name, including his own. Every brand ABG acquired after that, every big deal that they signed anywhere on Earth, quietly worked on Shaq's behalf. Own the licensor, not the license. Write that one down. When Shaq signed in 2015, ABG was a mid-sized licensing business, but ABG went on pitching Reebok, Forever 21, Brooks Brothers, Eddie Bauer, Sports Illustrated, Elvis Presley, Muhammad Ali, Marilyn Monroe, all their brands and estates and companies signed under the ABG brand. Then in 2019, BlackRock bought into ABG at a reported $4 billion valuation and became the largest shareholder. In November 2021, CBC Capital and HPS Investment Partners bought stakes at a $12.7 billion enterprise value. And in June 2023, General Atlantic put in another $500 million, with ABG valued above $20 billion. In 2016, the franchise portfolio came due. Shaq sold the entire Five Guys position. The restaurants were doing fine, but a buyer simply arrived with a number that Shaq did not want to argue with. Shaq converted a decade of operating grind into one large block of deployable capital. It landed at the exact moment he had somewhere better to put it. The structure Shaq signed in 2015 started collecting on its own 4 years later. In 2019, Papa John's was in the worst stretch of its corporate life. Founder John Shatner had stepped down after a series of controversies, sales had slowed, and customer trust had taken real damage. The company went looking for a face it could rebuild around. Read Papa John's own SEC filing and you can see who actually signed it. The filing says the endorsement agreement was executed with ABG Shaq LLC, an entity affiliated with Shaq for the personal services of Shaquille O'Neal. The joint venture got the contract. Shaq got the paycheck. Papa John's agreed to pay ABG Shaq $4.125 million in cash over 3 years and granted 87,136 restricted stock units. Shaq separately put in $840,000 for a 30% position in a joint venture that took over 9 Atlanta area restaurant Papa John's had owned directly. Endorser, shareholder, franchisee, and director out of one single negotiation. The partnership produced the Shaq-a-roni. Papa John's renewed Shaq in 2022 at $5.5 million in cash, plus 55,000 plus restricted shares, worth more than $11 million combined. Shaq then left the board in May 2024. The brand ambassador deal and the 9 restaurants stayed. By that point, the pizza company had already done its job in the portfolio. One business ran alongside all of it, and Shaq built that one from nothing. Shaq and his longtime partner Perry Rogers turned a conversation into Big Chicken. Authentic Brands Group and JRS Hospitality came in on the launch. Big Chicken had no playbook. Every recipe tested, every supplier found, every location teaching them something the last one had not. Big Chicken now runs about 50 locations with more than 350 in development. 7 years of grinding to build what Shaq could have bought a piece of in an afternoon. One system sits underneath all of it, and Shaq has been running it since the day he walked out on Reebok. Phase 5. The system you can actually copy. Shaq's portfolio might look a little random on paper. Google, Ring, Five Guys, Papa John's, car washes, an NBA team, a global licensing conglomerate, but 3 rules connect every single one of them. Rule 1, buy the habit, not the headline. Shaq puts money into products he uses himself and can explain to a stranger. Ring, Five Guys, and the car washes were all safe bets with high customer retention and were already working when Shaq bought into them. Rule 2. Build the floor before you reach for the ceiling. Celebrity investors often chase one exciting startup, throw money at it, and hope it prints. Shaq spent a decade buying businesses that generated cash, even on the ordinary days. That cash flow did two jobs. It funded the next purchase, and it meant his best assets never had to be sold to cover a shortfall. When Shaq retired, Turner paid for his life while ABG and Ring compounded in the background. Rule 3. Buy the machine instead of building it. Google already had users. Ring already had customers. Five Guys already had lines out the door. Papa John's had decades of operating history, and ABG already knew how to buy, grow, and license global brands. None of those required Shaq to build a business model from scratch. Somebody else had already done that work. Big Chicken is the one exception to this rule and also cost Shaq the most time, capital, and trial and error. Starting a business from zero is brutally hard, even when your name is Shaquille O'Neal. In 1992, a 21-year-old spent $1 million in an afternoon and went $80,000 into debt because he didn't understand tax withholding. 34 years later, he owns a piece of the company that owns Marilyn Monroe's estate, and if you want to see another operator run this exact same playbook in a completely different industry, that breakdown is on screen now. Different business, same structure. I'm Buster, and I'll see you next time. Peace!